Thank you everyone for still being so awake and alive on a Saturday morning. And I hope in the next 90 minutes or so in this panel where we talk about a debate about the state of the economy, we're able to keep you sufficiently engaged. And as Maulik says that I'll pick up the cudgels and stir controversy, that's not really my objective entirely. But I would like to start with a quote, and I would twist it a little bit from Bernard Shaw, that when two economists or when several economists are laid end to end, they're never really able to reach a conclusion. I'll say they're never really able to agree on a conclusion. So that is perhaps one of the reasons why we are here debating about the state of the economy. Whereas in most other countries, it's almost understood how the economies are doing. In India, we still don't really have a clear picture. Are we doing good? Are we doing not so good? Okay, so with that, I'll start by going a few steps back and starting with a big picture. And because it's a more macro 360-degree view of the economy in this panel, I thought starting with the big picture gives us some kind of a perspective. So I start from 1980 in terms of trend growth because we achieved independence in 47, and the first 20, 25 odd years, it was a struggle to learn how to become a democracy. And that itself, mind you, is not really an easy task coming out of decades and decades of colonial rule. Now, from 1980 onwards, GDP growth rate, now that's usually the most important macro indicator that we look at, has averaged at a rate of about 6%. And that's a pretty long period of time to have an average growth rate of 6%. And mind you, we were coming out of a Hindu growth rate of 3%. So it's impressive by Indian standards, it's impressive by world standards. And today, we are a middle-income country. We are a $2.3 trillion economy, and that's quite massive. We have a lot of things going in our favor. We are one of the youngest countries of the world with a very favorable demographic dividend. We have been able to reap the benefits of globalization. India today is a lot more integrated with the rest of the world than we were in the 70s and 80s. Our saving investment rate is by and large quite high. We have sophisticated modern world firms which are the engine of our growth. And we have been a stable democracy, and I can say that, I think, over the last 60, 70 years. And given our level of GDP, it's the only country in the world with a successful democracy. And that should not be underestimated at all, because that is a huge achievement by itself. So overall, the outlook is very good by global standards. Okay? So we have come a long way from where we started, and we've been doing reasonably well on a trend picture. Now, in macroeconomists often talk in terms of a trend growth rate, like a long-term trend growth, the highway that never ends, and in terms of fluctuations, or what we call business cycle fluctuations. So on a trend sense, we have been doing quite well compared to our peers, compared to our own past. But what happens when we now zoom in a little bit and take a look at the more recent years? And this is more in the sense of fluctuations as opposed to that trend growth. Now, in terms of recent years macro indicators, some of the indicators that we all like to talk about is one, of course, is inflation. Consumer price index inflation is remarkably, it's down at a time when it was about 10, 11% between 2009 and 2012. It's down to the latest numbers show it's down to 5%. And that's remarkable. I mean, given the inflation targeting framework, it's within the range of the target of the central bank. Fiscal deficit seems under control. The finance minister announced it's around 3.5% of GDP. That's a big achievement as well. We have been conservative with our fiscal policies. Current account, that's another remarkable achievement. It's likely to post a surplus after 9 long years of deficit. Of course, we can debate what is the source of the current account deficit coming down. It's mostly because imports are going down, not as much as exports are rising. But still, it's coming down. On the other hand, if we look at some of the other main drivers of growth, what macroeconomists conventionally call the drivers of GDP growth, if you look at private investment growth rate, we see a very different picture there. Because private investment growth rate in 2015 was actually close to 0. And to give you a perspective, compare that with the boom years of 2003 to 2009, when on year-on-year average, it was about 15%. So that shows how much private investment has declined in the last decade. Exports, another big driver of GDP growth, especially for an emerging country like India. Exports fell 5.2% in 2015. Compare that again with the boom years, 2000, 2008. Exports were increasing at 16% per annum. So when domestic demand has been increasing at 5 to 6%, even during the boom years, exports were growing at 16%. So that was a much bigger driver of our growth. So investment and exports definitely have not been doing so well, but on the other indicators, we seem to have macroeconomic stability, as Mr. Mahalingam mentioned as well. So again, the most important indicator, growth rate. If you look at 2015 GDP growth rate of some of our emerging economy peers, and mind you, some of these countries were also in the fragile 5 group during the taper tantrum of 2013. If you look at Brazil, if you look at Russia, their growth rates are negative. If you look at Turkey, South Africa, they were nowhere close to us. India, during this really gloomy global outlook, is growing at a staggering 7 to 7.5%, which basically makes, and given that China is growing at 6.9%, this makes us the fastest growing large economy in the world. So starting from where we started till today, that's a big, big journey to have come, to have traversed, and to have a growth rate of 7.5%, and maybe it's going to keep increasing at that rate. However, the caveat there is, given that I quoted the investment and exports number, in the post-Second World War period, that's a long time, 70 to 80 years, India is the only country, and we have looked at the data, and I have to thank Josh for that. India is the only country with falling investment and falling export, but a greater than 7% GDP growth rate. That's a staggering statistic. You look at all countries around the world from in the post-Second World War period. It's the only country today with falling investment, with a negative export growth, but a 7.5% GDP growth rate. In other words, we are moving ahead at a breakneck speed. When the rest of the world is floundering, it's stumbling, it's struggling with their own problems, we are roaring ahead at 7 to 7.5%. Is India a miracle story? Is it a rare event? Is it something that, that has not happened in the last 70, 80 years? Or are we really missing something here? Okay. So to answer that question, I look at some of the other statistics. And oftentimes the aggregate picture may not really show the true story in the ground reality. So I zoom in even closer. I look at the micro data. I look at what's happening with the firms, with the banks, with investments. Firms being the engine of growth for any country, what's happening in corporate India? And this is not unknown to the audience here. This is a graph taken from the Credit Suisse report that came out recently. It basically shows the stress building up in the corporate sector. The bars are essentially showing what is the percentage of debt with companies that have interest coverage ratio less than 1. Okay, so these are companies which don't have sufficient earnings to cover the interest payments. And the data shows that more than 40% of the debt is with companies with interest coverage less than 1. Okay? Staggering about 30-35% of debt is with companies which have interest coverage less than 1 for consecutively 4 quarters. Okay, so the corporate sector is in severe credit distress. Let's take a look at banks. Again, it's not unknown to us. After RBI's asset quality review that was started last year, the recognized stressed loans is estimated around 11% of the total advances. Credit Suisse has an estimate, if you take restructured loans as well as unrecognized stress, taking into account worst case scenarios, the overall stressed loans in the banking sector stand at 18% of total advances. That is a staggering number, given the size of the banking system. If you just look at PSU banks, it's 20%, more than 20% of the total advances. And the banking sector has become so credit shy that we all know here that the corporate credit has completely dried up. Whatever lending is happening is on the retail side, but in terms of corporate credit, it's completely dried up. Okay? So the firms are in credit distress, the banks are in credit distress. And so there is definitely a disconnect between what we see in the macroeconomic GDP numbers and what we are seeing from the engines of growth, the firms, the nerve center of the economy, the banks. And this is a snippet of a recent debate that happened on the GDP numbers, that the same number is getting interpreted in 2 different ways by different people. And this is not a new debate. It has been happening over the last 1.5 years since the CSO released the new GDP series. Okay, so it's called now the Great Indian GDP controversy, what have you. So there is a disconnect. What we are seeing in terms of that miracle story of 7.5% growth rate is not getting translated into what you and I are seeing from the ground reality. To dig a little bit deeper, and I have my own reasons, and that's for another day, another forum, maybe almost a 2-day conference of what's wrong with the GDP numbers. There are problems with official databases, be the National Account Statistics, Index of Industrial Production, the IIP, the MCI 21. There are issues, and economists are exploring, are digging into those issues. So they should be treated with a little bit of caution. What we can look at is micro databases, which are a lot more transparent, because you get to see all the data, you get to see the underlying records that the private sector actually uses. So what we look at is, we look at nominal quarterly numbers of listed non-finance, non-oil companies. Okay? And what do we see? This graph shows you the net sales of the listed non-oil, non-finance companies in nominal sense. I'm not even going into the whole inflation effect. In nominal sense, and what the gray bars show are the business cycle recession dates of India. So according to the old GDP series from 2011, 2012, 13, we were in a business cycle recession. If you look at the recent few years, the net sales of the companies have stagnated. 2013, 14, 15, and in fact recently it's actually coming down. The next thing that we look at is exports, and it's even more mind-blowing. This is again exports of the same listed companies, goods and services exports. And it's staggering, it's, again, nominal numbers. The exports are coming down in, as I said, a mind-blowing way. 2013, 14, 15, it's a negative growth. Okay, so when we look at firm-level data, there are problems with the net sales, there are problems with operating profit, problems with revenues, and problems with exports. The next thing we look at is investment, because that is, again, a very important driver of growth. We look at investment projects that are announced and investment projects that are under implementation from the Center for Monitoring Indian Economy's CAPEX database. And it's a fantastic micro-level database where you actually get to see the number of projects and track the progress in a time series sense. And we focus on 3 indicators. And these are very important statistics in terms of investment. One is private announced projects, which basically gives a feel of how confident is the private sector about the macroeconomic scenario in announcing new, or in announcing new projects. The second is investment projects, infrastructure projects under implementation. Now, infrastructure is one of the biggest sectors of investment. This measure shows what is the actual investment activity in the infrastructure sector. And third is total projects under implementation. That gives a sense of an overall demand in the economy. Okay? So what do we see? What picture do we see from these 3 indicators? This is private announced projects. Okay? So how confident is the private sector and is announcing new projects? The first thing that will strike you about this graph is the decline from the boom years of projects being announced to the recent periods of the last 5 to 6 years. The trend has completely shifted. And in the recent years, there's one spike during Prime Minister Modi's election of 2014. Other than that, the quarter-on-quarter percentage change of private announced projects has pretty much been stagnant. And overall, coming from the boom years, we have hit a completely different low altogether. When we look at infra projects under implementation, it's the same story. We have been dropping, and over the last couple of years, last 2-3 years, it's been a very, very gloomy scenario in terms of infra projects as well. And we know that infra projects, nothing is being announced, nothing is really getting implemented. Overall projects under implementation, the same story. A declining trend, last few years, it's hovering around the 0 line, it's pretty much being stagnant. So going by any indicator of investment demand, investment activity, it has been stagnant. When we looked at exports of companies, goods and services, that has been declining. So 2 of the major drivers of growth in the economy are not really working. They have been sluggish. So what does this mean? Does it mean that India is not a strong performer after all, from what we have seen with the other macro indicators from the GDP numbers? Because it seems that the business cycle recession that we experienced in 2012, that has not really ended, going by these statistics. We're continuing in that kind of a downturn. firms and banks are in stress, and our export and investments are sluggish. Okay, so that does not really paint a very gloomy, a very hunky-dory picture. And if we go with that picture, then the question is, how do we get back on track? If you agree that, okay, we are not doing as well as we should, and we are not achieving our potential, that's something that macroeconomists look at as well. How should we get back on track? What should be our plan going forward, especially in the context of a turbulent economy, turbulent global economy, when we are unlikely to get much help from the global tailwinds? So there are a lot of cracks that have not gotten fixed over a long period of time. I mean, we had a boom period when we were all euphoric, a lot of investments, a lot of credit boom, and then we hit the global crisis, and then since then we have been struggling with other problems, but a lot of underlying cracks have not yet gotten resolved. There are massive distortions in land, in labor, in capital markets, and I mention this because these are very important inputs into the overall production function of the economy that produces GDP. We do not have sound regulatory organizations. Our regulators oftentimes get more involved in over-regulating the markets rather than helping the markets grow and develop. We definitely do not, we're not doing very well on what we call rule of law, which is basically, there should not be any arbitrary exercise of power by the regulators. So there needs to be clarity, accountability, and transparency in all the regulations, in the way the laws, the entire legal structure, the way it operates. And we are not doing very well on the rule of law index either. And we have inadequate state capacity. We keep announcing reforms, we keep passing laws, but does the government, do our regulators really have the required adequate capacity? Do we have the institutional setup to see through the implementation of these laws and reforms? And we have our doubts on that. So what are the big areas of reforms? And this is not just over the last few years, it's an overall picture. What have always been the big areas of reforms for India? One is, of course, macroeconomic stability arising from fiscal and monetary policies. On monetary policy, of course, we have had a watershed event in terms of an inflation targeting framework. For the first time in Reserve Bank of India's history since 1934, when the RBI Act was written, RBI finally has a clear mandate, has a clear objective of monetary policy, which is price stability. Till date, monetary policy was conducted in an ad hoc, discretionary manner with no clear objective, no clear signal to the financial markets as to what the RBI is looking at. It was looking at trade balance, capital flows, output, exchange rate, a whole myriad of indicators to decide monetary policy. For the first time, RBI has now been pinned down to that one accountable objective, which is deliver low and stable CPI inflation on a sustainable period. And that is a very big change for monetary policy. On fiscal policy, something is getting done. It's not as big, but we are doing fiscal consolidation. There's an FRBM committee thinking of fiscal rules, but the thinking on that front is not as deep as is required. Tax policy and administration, of course, this is massive. With the goods and services taxes, as we all know, I'm going to quote Sajid Chinoy of JP Morgan in one of his other panel talks that he delivered, that the GST for India is almost like signing a free trade agreement with ourselves. Because now instead of 30 markets, we're going to have one market. And that is a revolutionary step for doing business in India. So it is massive. And of course, we have just seen the tip of the iceberg. When we say we have done GST, of course, that's not even halfway true. We have just started the process. And that's going to take a long, long time to show effects. Labor laws, we are floundering on it for a very long time. Some states have done it. A lot of other states are falling behind. Land law, as we all know, and since I come from West Bengal, I know this very well. We are definitely not doing very well on reforming our land laws. Financial reforms, and that's something that the second panel is going to focus on a lot. We do tinkering on the edges. We make some announcements to clear up the bank balance sheet. We form a bank board bureau. We do asset quality review. But no structural, no fundamental reform has yet been announced to say that, okay, 5 years later, we will not have the same bank NPA problem. Late 90s, early 2000s, we had the same bank NPA problem. Years later, we are having, again, the same bank NPA problem. We keep coming across this recurrent problem, but we are not fixing the underlying cracks so that we can once and for all say that the banking sector is sound. And that is very important in a country where the bond market is not very well developed. And the primary source of capital for a large number of companies today in the country is the banking sector. And if the banking sector has become credit shy, where do we go to raise capital? Currency market, derivatives market, equity market, and I don't want to go on and on all of these. So there are a lot of reforms that are required on each of these markets. And of course, last but not the least, infrastructure, where we keep deciding how much money is needed, we know what projects have to be announced, but nothing really takes off on the ground, and we are still where we were 7, 8 years ago in terms of infra projects. So in other words, all of these reforms have to be initiated to create a favorable environment where our firms can make GDP. And we are not giving our firms that favorable environment, either in terms of financing or in infrastructure or in terms of other reforms. So a few takeaways as I end this talk. The last time we had a business cycle recession was late 90s and early 2000s. And that was again the time when our banking sector had serious NPA problems. To a large extent, we were pulled out of that recession by a very strong global economy. We got very good macros. We had a good GDP growth rate. We had low inflation, low interest rates. And the world economy was growing at a good rate. There was an overall feeling of macro stability. It is very unlikely that that is going to get repeated this time. Because the global economy today, as Mr. Mahalingam also mentioned so eloquently, is in a very, very different state altogether. They are struggling with their own problems. Advanced economic growth rates are by and large less than 2%. So, and the other worrisome part is there is a lot of force of deglobalization, be it Donald Trump in the US or be it UK Brexit. The deglobalization forces are gradually gaining traction. And that can have very serious repercussions for a country like India when we can no longer depend on the global forces of trade to take us out of a slow growth rate. Okay, so it's very unlikely the global economy today is going to help us do that as it did last time around. What that means is we have to fix the cracks ourselves that we have been postponing for a very long time. And we should be prepared that by the time the global economy recovers, however long it may take, we should be able to reap the benefits of the recovery of the global economy. There are a lot of committee reports, a lot of great men, Percy Mistry, Governor Raghuram Rajan, UK Sinha, Justice B.L. Sri Krishna. All these committee reports have given us the roadmap of what we should be doing ahead. And a very small percentage of these recommendations have actually been implemented. And a few things that I want to leave you with is we need to focus on implementation. There are a lot of big ticket reforms that we have started. GST, the bankruptcy code, Aadhaar, which is transformational, and inflation targeting. But all of these reforms will take 5 to 6 years at the least to start showing impact. With bankruptcy code, well, we went from socialism without entry to capitalism without exit, and the hope is the bankruptcy code will take us out of it. But it is going to take a long time, and we need to be able to do very good implementation if any of these reforms are to show effect. Just passing a law is really not, it's not even half the battle won. It's the easiest part of the entire struggle. Second is there are a lot of long pending reforms that were initiated, but that got lost somewhere down the line. And we need to revive these long pending reforms. A very big example of that is the Indian Financial Code. It was a mind-blowing piece of legislation to reform the entire financial sector, but nothing has been done on that front for the last 3 to 4 years. Okay? And finally, of course, what we need, and it's a much more long-term structural change rather than the tinkering on the edges, we need to build sound regulatory and overall sound good quality institutions so that we are not as affected by the global turbulence, by the global uncertainty. And given the favorable factors that we have that I started off with a young country, with a lot of growth momentum, we're able to realize the potential that we have. So in summary, my takeaway is India is perhaps not doing as well as the GDP numbers show, but there is a lot of potential that we can do better. And however, there are a lot of steps that need to be taken. There's a long way to go before we can achieve that. Okay? So with that, I would end my part of the talk of the panel. And now I would request my panelists to please come on the stage. Josh Feldman. And can we please have a round of applause as they take the stage? Josh Feldman, Jayesh Mehta, V. Tyagarajan, Upasna Bhardwaj, Shantanu Sengupta, and Jairam Krishnamurthy. So each panelist will have about 5 to 8 minutes to give their own talks, and then I'll open the floor to Q&A and have a more interactive discussion. Thank you.